Hello guys, today we try to see 11 things to exit a trade. It means a lot of people, they exit a trade but they don't analyze why they exit this trade. Okay, it means when it is a loss. Okay, so I will just give you 11 things one by one. We try to study them. If you have more ideas, please comment on this video, and please subscribe if you haven't already. Okay, so we begin with the first one, which is bad search criteria. Now, bad search criteria, what does it mean? It means when you want to buy a stock, what is your criteria? Okay, some people, they just buy at random. They like a chart, they buy a stock. He goes to a forum, someone tells them that this is the best stock in the world, so he take the ticker and he buy it. Some, they follow gurus and they give them a list of stocks each day and they buy them. Some also, they text them list or one stock and they say buy. It means all the people, they just buy but with bad criteria. And this is a real problem in trading. If you don't have something solid, strong to search for stocks and know why you buy the stock, this is a very, very important thing. Okay, for me, all the guys who are following me, they know you can just go and check training level 2, which is how to search for stocks using stock screener, or you can use by industry index, or you can buy from like a support line, which is training level 13. Okay, so these are some criteria you can use, which is my criteria, and you can use them because you say, oh, to buy from support line, it's very easy. Any support line, you take it, okay, and you buy and you make money. No, it doesn't work like this. If it is so easy, so everybody knows what is resistance line or support line or whatever line, and they just buy and make money. It's not as easy as you might think. There are other criteria that you should see. And when we say support line, there are many support lines. When you say resistance line, there are many, and this is the problem. So this is number one, which is bad search criteria, so as you might know. And number two, we try to see tight stop loss. Now, there are a lot of people, when they hear stop loss, a lot of people, they comment on my videos, or sometimes they ask me, and they think it's just easy. A guru told them, oh, okay, stop loss is so easy. What is it, stop loss? Put 2% for all the stocks and just go. Or someone tells me, oh, just put 10% and go. 20%, 5%. It means they don't know what they are doing. Each stock is unique. It's not the same as the other stock. I'm telling you, even the stock, when we have two stocks, they have the same price, but when you put stop loss, they should be different. They shouldn't be the same. Why? Because there are criteria that there are guidelines that you should follow in order to calculate stop loss. Stop loss is tricky. Okay? And those who are experienced traders, they know what I'm talking about. Those beginners and those they just follow videos online like this for free, and they say, oh, just go 2%, 5%, 10%, and then someone put 20%. Okay, you put 20%, and if the stock goes to 20%, you lose 20%, and this is a big loss, and it's not stop loss. So there are a lot of things that you should know about stop loss. These are guidelines. So stocks are not the same. Stocks are like a human being. Okay, they have a character. They are not the same. Some are slow, some are running, some are jumping, some are sleeping, some are crawling, some are swimming, some are diving. So each stock is not the same as the other stock, so you shouldn't do the same thing for every stock. Okay, so this is number 2. So number 3, number 3, we go to another thing. Okay, number 3, earning news. Now, earning news, sometimes it gives you good news, sometimes bad news. So, what is earning news? Earning news, each quarter, it means 3 months, company announces the earning per share. And the analysts, they have a number. Let's say they say $1 is the earning per share. It means if you own 1 share, you get $1. Okay? Now, if the company news, if it is better than 1, let's say $1.50, there will be a surprise. So a lot of people, they come and they begin to buy the stock. That's why in the morning you will see a gap up. Now, if it is $1 and the company gives 95 cents or 60 cents or 50 cents, it's bad news. So a lot of people who are short sellers, they come and they short sell the stock, and the next day you will find a gap down. So then when it is a gap down, it's a result, and then you exit the trade. So in the future, if you are going to buy a stock, try to see the earning news. If you like surprises, either gap up or gap down, okay, hold the stock. If you don't like and you are scared to death, because there are some people who are scared, for me, I have never been scared of earning news. I don't care. Okay? If it gives a gap up, welcome. It's good money. If it is not, if it gap down, okay, I have some measures to protect my account. Okay? Now, let's go and see number 4. Number 4, let's say here. Number 4 is volatile stocks. So what does it mean, volatile stocks? Volatile stocks, it means these stocks are they go fast, either up or down. It means you don't expect what this stock will do. It can go $5 up, the next day it goes $7 down, $3 up, $2 down, and then $1 up, and then $6 up. So this stock is so volatile because there are a lot of day traders, and they like these stocks and they play with them. So understand that the winner is those who can force the stock either to go up or to go down. There is always a fight between short sellers in the world. Some, they think that the stock is going down, so they short the stock down. Some other people, they think that the stock will go down a little bit, but it will go up, so they buy heavily. So there is a fight. So when there is a fight in this kind of stocks, it will be volatile, going up and going down. And if you don't know how to put stop loss for those kind of stocks, you will be always exiting. Okay? So let's go to number 4. Let's go to number 5. Number 5, stock or stocks opposite industry trend. Okay? So this kind of stocks, it means in general you find that this industry is good, and you go online and you find that the industry is going up for 1 month or 2 months or 3 months, is good. But in this industry, there are some stocks that are bad. So you come because you think that the industry, all the stocks will follow the industry, and you go and you buy this stock, and you don't, even you see that it's going down, but you think it will go up. Okay? So try to be careful. If the stock, I just give you this information to make sure you understand, a stock that it is going down and the industry, its industry, it means the industry it belongs to is going up. What does it mean? It means mutual funds manager, they buy a lot of stocks in this industry, so it's going up, but they don't buy this stock because they are selling it, and there are short sellers that come to this stock because maybe this company has problems. Because the stock, you know, who plays with the stock? It's the people who are in the stock market who plays the stock. It's not the company. Okay? Sometimes the company is doing good, but short sellers come with a hedge fund and they short it. Okay? Because they expect that this company will not do good, so they short it. So whenever you see a stock is not doing the same as its industry, understand that there is a problem in this company. So you should dig inside and you see what's going on, and hope you are not investing in this stock in this company, because you will be the best loser in the market in that year. Okay, when the stock is going down for 2 months or 6 months and it's going down, and you buy it and it's still continue to go down, and its industry is going up. This is a real problem with the choice of stocks. And when you see something with a price and you don't believe it, because you are following a guru and he tells you, okay, this company is the best company in the world, just buy it. Or in TV recommendation, or a guru in TV, or someone who is very, very famous, and you say, don't worry, you are an investor. The price doesn't matter, because it's just fluctuation. Okay, it's just the stock swings. But understand that when mutual funds managers are selling this stock, they don't want it because they know there is a problem. No one will tell you to buy. But if you follow people, okay, try to follow people and continue. Because if you don't buy the stock by yourself, it will be a big problem for you in the future. Even if you make money from someone who tells you, oh, buy this, because people, they talk. If I tell you, okay, that stock will go up, that stock will go down, it's just predictions. Okay? How do they know what the people will do in the future? And try to think logically about the price in the stock market. Okay? If you see the price going down, it means there is a reason. And the reason is that without having the fundamental reasons, it means you go to find reasons outside the price. Think about this. When there is a lot of supply in the market, the price will go down. Supply, it means everybody is selling. Short sellers are selling. They sell shares that it is not theirs. The people who are invested, they don't want to sell their shares. But short sellers, they borrow these shares and they sell them. This is a real problem, but it happens only in stock market. Okay, it happens always in stock market, so it's a game of stock market. Now 5. Now we go 6. 6 is buying from the downtrend. This is another problem. A lot of people, they see a downtrend and they think this is the time to buy. Okay? Now they buy. Unfortunately, the stock continues to go down. So they miss the point where the stock will go up. Understand that some stocks, when they go down, they continue to go down for years. Sometimes they go bankrupt. So if you see a stock that it is going down for long, for 6 months or 1 year, try to see what's the problem with this company if you are an investor. Okay? Don't just because it's going down, you see it's an opportunity to buy. This is what some people say. Opportunity to buy. Who tells you that it is an opportunity? Have you checked the company? Have you checked the short sellers? How many shares are shorted? Do you know something about this company? Have you seen, for example, the balance sheet, the debts, the assets? Have you seen the earning? Does this company make money? It means making more money each year. Since the price is going down, that means that there is a problem. But for us, for me, like swing trader, I don't care about the real reason. Why? Because sometimes you can't know. But for me, the price is the only reason that I trade. If I buy a stock and it trends up and I will be making money, it is sufficient for me. I don't want why the stock is going up. The only thing I know is some people are buying. That's it. And this is enough for me. Now, if you are an investor, if you want to invest in a company for many years, you should see the earnings, you should see the balance sheet, you should see the competition, you should see what this company is doing, because you are staying too long. 2 years, 5 years, 10 years, 20 years. And if the stock is going down for 6 months, 1 year, 2 years, it means there is a problem with this company. The mutual funds, they are intelligent. When they see a company has a trouble, they don't buy it. Okay? They sell it. If they have shares, they try to sell it and get rid of it. Especially when the noise, there are a lot of noise in the stock market, and when they say the company is bad, all the people, all the mutual funds are selling, and you are going to buy. Okay, big guys are selling and you buy. Do you think you can? You are so strong to stop the price and make it go up? I don't think so. Okay, so number 6. So number 7. Number 7. Stock full of short sellers. What does it mean, stock full of short sellers? A lot of people, when they see the chart, they don't understand what's going on. But if you follow my strategies, you will understand how this chart is made of. When you see it, you can see a good chart and you see a bad chart. A bad chart, one of the things is short sellers. I can't say too more. Short sellers, it means they don't let the stock trend. Whenever it goes up a little bit, they short it. Then it goes up a little bit. So there are some people who are just playing, day traders playing with the stock, so the stock doesn't trend and it goes nowhere for many years. Until someone who is very, very strong and he kills all the short sellers. When it is, for example, a mutual fund, he has like 50 billion or 100 billion, and he tries to, and he knows that this company is good and he wants to push it up. So those short sellers, they lose all their money, many days, many weeks, and then they get rid and they go to another stock. This is how things work, because they can't anymore short sell the stock, because there is someone who is so strong to push them away. Because when you short sell a stock, it goes down. If there is someone who is bigger than you and he buys all the short sellers, because, you know, a mutual fund, he has billions of dollars to spend. Now, short sellers, they have millions, yes, 100 million, 200 million, all the people, yes. Or it could be 500 million, it could be even 1 billion. But understand that mutual fund, when they come, they become 10 million or 20 million, and they crush every short sellers. So this is the thing. But when you see a chart like this, you buy, the next day it goes down and you lose, and then you exit because you can't stay more. And 2 days, 3 days, they shorted good. Okay, so you don't understand anything and you lose a lot of money, and then that's why you exit the trade. Now number 8, stocks trading into a range. Now, what does it mean, stocks trading into a range? It means the stocks, when you see them, you will find they have the top, which is what we call the resistance line. It means it's just virtual. It means when you put a line, you see that those guys, they push the stock, they push it. When it reaches the resistance line, they stop buying. And all the people think that it is the end, so they short it. So most of the time, these guys are day traders with a few swing traders. Okay, just few. So they play with this going up and down, up and down, up and down, and you see this in the chart, and it can take 1 month, 2 months, 6 months, 1 year. It can take a long time. So whenever you buy this stock, you are just wasting your time, because you buy today, tomorrow it goes down, then you make $100, $200, $300, and then after a few days you lose all these $300, and then you go down to $100, $200, $3, then it goes up. So it's just a play. There is no trend, there is nothing, and you are just wasting your time, and then you exit, and then you see that you exit a lot. So when you exit a lot, you should see what is your problem. You are doing some problem in your trading. That's why you exit a lot. Okay? Now, number 8, we have seen it. Number 9, which is another thing. 9, buying at the end of the trend. And you say to yourself, why I should buy at the end of the trend? I will tell you why you buy. You buy because you see the trend which is so nice, and you want to enter, but it is over. The trend has been 6 months going up, and the stock was $10, now it is $50. But because you accept this situation, because you like the chart, because of you will be with the winners. So you say to yourself, I just buy, maybe it goes up and I will make money. Whatever you buy, it's the dead end, and the stock will be going down, and then you exit the trade. This, most of the beginners, they like to buy at the end of the trend. Okay? For us, like swing traders, we don't buy at the end of the trade, the trend. When we see the trend, it's over. But yes, when it is the beginning, yes, you can enter. But for us, we buy from the first day. This is the best we can do. Now you say to me, how you buy from the first day? We buy because of the criteria that we use. And if the trend doesn't continue, it means that it is just a fake beginning. Okay? And we see another stock. There is no problem with that. But if you see a good trend, sometimes some people, even in the media, they talk about it. They talk about stocks, they talk about mutual funds, they talk about what we call ETFs, because it tracks indexes. And they advertise a lot. They say, oh, this stock has done 80% in 6 months. It's a good investment. Come and invest. Now, since the trend has ended, okay, and it's nearly to end. Now, they will never tell you that the stock can go down. They will never tell you this. They tell you it's a good investment, as if you are going to invest for the long run. It means you become an investor. But when you want to become an investor, you shouldn't see just the price, but you should see the company, if it's doing good or no. Okay? So buying at the end is most of the time the result of advertisement of TV, websites, and other people who are selling something. Or they want to sell off their shares while you are buying, and this I have explained a lot of times. Okay? So both of these things, buying from the end of the trend or buying from the bottom, which is the downtrend, these are two things that the people, the beginners, they like. They think they are so smart. But you know, the market punish everybody who doesn't understand how the stock market works. Okay? And the people, they like to be with winners. For example, if you see a stock is going 100%, let's say it was $10, now it is $20 in 6 months, you like it, you like the chart, so you buy it. But you don't know that this trend will end and you will be losing money. That's why you exit the trade. Now, 10, big loss. Now, what I mean by big loss is what? Big loss, it means that, for example, you buy a stock, it's going against you, but you don't exit the trade. You wait, today, tomorrow, next week, next month, after 2 months, 3 months, and the stock is going down, and you don't take a decision to exit because it feels so bad to exit, and you say, if I exit, it will become realized, as someone tells me. Someone tells me that if you don't sell, you don't have a loss. I say, what? Okay. I say, if you buy a stock at $50, now it is $2. It is $2, you see it, and you don't make any loss. He say, no, I don't make any loss. Okay. Stay until the company will be bankrupt. Okay. So this kind of ideas, it means some people who exit the trade by pain, by having a big loss. This one of the characteristics of beginners. It means they leave the loss become big and big and big until they can't make it. Okay? And number 11. Number 11, no risk calculation. No risk calculation, what does it mean? It means when you buy a stock, you don't want to think when to exit. So if you don't know when to exit, how can you calculate your risk? Because calculating the risk is the most important thing in trading. Don't think about the profits, because the profits you will never know. And you can't control them. You can't control how much the stock will give you. Okay? You can't. This is in the future. No one knows. But when the stock is going against you, you can control it. It means I can exit at any time I like. So it is in your hand. Now, when it is in your hand, you should specify which price you will exit the trade. Okay? So by precising the thing, you will be calculating the risk, and then your account will not shrink very, very quick. Even if you lose a lot of times, it doesn't matter, because you will be making money in other stocks, and you cover your loss, and you will be doing very good. But if you don't calculate the risk and the stock is going down and you leave it and after 1 month you find that you lost 50% of your money, believe me, you will not succeed like this in trading. Trading is a business. Okay, so let's go and see. Okay, and see all what you talk about from the beginning. Okay, so we have said the bad search criteria, tight stop loss. Okay, so tight stop loss, I think I have explained it, if I'm not wrong. I will repeat with this tight stop loss. Tight stop loss, what does it mean? It means if a stock is going $1, okay, let's say it goes $1 today, and you put stop loss at 20 cents down where you bought. This is a real problem, because next day any fluctuation you will exit, and this is one of them. So hope guys, with these 11 things you have clear idea why you exit the trade. There are a lot of things you can add according to your experience, but the more you trade, the more you will see things. It could be things related to you, things related to the market, to the industry, to the techniques that you use, a lot of stuff. And trading has some rules that you should follow. Although the rules, you can do the rule as yourself, okay? Make the rule for yourself and apply it and see the result in the future. If you are in doubt, you can, for example, comment on this video section, or you can send me a private message, and I will answer. For my students who are with me in the subscription, or they bought my training, they send me emails, and I will make videos for them for the subscription, and they will watch them all. Okay, so thank you very much for watching. Please comment, share my videos, subscribe to my channel if you don't, and see you next video.